Alright, hello and welcome to Camel Finance. I'm your boy Camel, and I want to start by playing you a clip from yesterday's video. So I'm looking at this, and the first thing I see is that we have a breakout. Now, ordinarily in a bull market, every breakout like this is bought, okay? So this would be a long. I'll tell you why it's not, because we're in a bear market. It's also not because this is actually out of sync with Bitcoin. So the Bitcoin 60-day cycle low, first of all, isn't due for another 5 sessions or so. So I'm proceeding with caution here because 1, we're not in a bull market. 2, we haven't had a drop into this cycle low for Bitcoin yet. And I would think if Bitcoin drops, then this is going to drop into the cycle low too. So maybe that comes in the form of a retest and then we can go. But for now, I'm not super confident about buying this breakout. Fast forward to today, and you can see that not only has Bitcoin started its drop into its cycle low, but Ethereum is possibly going to signal that that was a bull trap. It could be a retest and a go. I did say that some really nice action would be for us to come up here, drop down into this cycle low and then go. Get some sort of price action like this, maybe a bounce off of this line, a drop down into this cycle low and then go. That becomes an enormous high probability setup for me. And so you can see that is essentially what we're doing. We just missed this line a few ticks away. We are apparently coming in for a drop into this 60-day cycle low for Bitcoin, as denoted by this green vertical line. And you can see, and likely that when we get into this timing band and form a proper swing, this is going to end up showing us some kind of a technical breakout. So looking to line up along from around this area. Been lining it up for a while. We're getting very close. Whilst we're in the charts, I'm just going to breeze through a couple of them and we'll do the charts first, because we can do all the technical analysis we want. The dollar is apparently bid, risk is coming off. We can see this in Bitcoin and Ethereum. We can see this in the stock market, as you can see here. The NASDAQ as well, also down here getting crushed back below this level here. So all of this kind of has got a bad feeling. The VIX still hasn't quite cooled off yet, but it's also refusing to fully spike, isn't it? So keeping an eye on that. Keeping an eye on this as well. This is slowly becoming more buyable in my opinion, but still a bit steep for me. Is this finally the cycle low that's forming? Is silver just about to complete a trap and a stop sweep before going again? Are we about to break out of here? The miners are still hanging on. So, you know, a look across the board, it's got a very bearish feel. A lot of people think that we have to crash 50%, but ultimately it all comes down to this CPI print on the 13th, which is Tuesday of next week. So proceeding with caution up until the 13th. I really think this is make or break for markets, and that's why I'm not going to spend a whole deal of time on the charts going forward until then. But if we get a hot CPI print, if it comes in high, then you can expect everything to get crushed. And if we get a low CPI print, then I expect for us to find some true cycle lows and get enormous risk on rallies coming out of here. I have been saying the lows are in for a while, and I don't see why this can't continue to be the thesis. The only thing I think that will take these lows out is a hot CPI print. So it's really a strange time for trading. It's really a strange time for analysis, because you can do all the analysis in the world, right? But it really all does come down to this CPI print. Either the lows are in, the bulls would argue the lows are in, that we're going to get a low CPI print and we're going to go out of here. And that's kind of what the cycle count is telling us as well. If you think about it, the cycle lows are due. We're due to get a bounce. This is true of Bitcoin as well, as I've already shown. So all of this kind of tells us that around the 13th, we're going to get this CPI print. It's going to be low, and then we can bounce out of here. But that remains to be seen. There's no point front running this. So a little bit more patience. And once we get clarity, we know that if the CPI is hot and we take out the lows, then easy shorts, 50% down, right? And if the CPI is lower than expected, then we know big longs out of the cycle lows and look for enormous risk on rallies to occur across the board. The biggest bank in Singapore is going to offer Bitcoin and crypto to 300,000 institutional clients through its mobile app, according to the Financial Times. So here's the article if you want to go and see that. This is absolutely massive news. We continue to cover on this channel the adoption of Bitcoin, and I'm sure this is a trend that will be continuing to continue. Bitcoin as a store of value is gaining traction, according to Bloomberg. And I think it's important to point out that you really don't want to let price distract you at the moment. A lot of people are focusing on the price. A lot of people like to pick bias arguments. They just select the top of the chart and say, oh, look, we're 70% down from its highs. It's failed as a store of value, this, that, and the other. But if you actually look at it properly, if you actually look at it over a longer term horizon, if you look at the price of standard food items like eggs or corn priced in Bitcoin over the last decade, then you can see this is the best store of value the world has ever seen. And all of these people that think it's failed as an inflation hedge, you know, all it would take is for Bitcoin to start its new cycle and a new bull market, and it will very quickly find its way to new highs. And everyone that said it had failed as a store of value will have to eat their words. And let's be honest, we all know this is coming. It's only a matter of time. And these big institutional providers, institutional clients, they all know this, right? We've seen BlackRock move in. You know, they're moving in to crash it to zero, are they? It doesn't make sense, does it? We know this thing is going up. We know this thing is about to start a new bull market. And I myself am very much looking forward to it. Over in Germany, they've just approved a 65 billion euro inflation relief spending package. So, of course, everyone likes to cure their inflation problem by creating more money and thus higher inflation. We live in a cuckoo world. The next decade of Bitcoin dominance will be driven by a combination of a couple of things. One, the continued digitization of the real world value, and two, trillions in wealth transfer to Gen Z/millennials. And there's 4 charts here that show the whole story. So this is the first one. The intangible assets make up 90% of the S&P 500's assets, and this represents 21 trillion in value. This is more than 5 times that of the tangibles, like buildings, equipment, and real estate. So you can see that back in 75, the examples of intangible assets versus tangible, like buildings, tangible of course being buildings, cash bonds, inventory, intangible, patents, brand value, customer data, software. And as you can see from 75 onwards, they've gotten rid of actual tangible assets, things that can be exchanged for cash. And we've moved much more to like data collection and BS on social media, right? So let's keep going. The disposable income for millennials is predicted to 5x to over 7 trillion by 2030. As this money shifts hands from old to young, so do the preferences for how that capital will be deployed. So in other words, people that are in the millennial generation, they are going to end up with far more disposable income as they advance their careers and continue to age. And as this money starts to build up, as these millennials start to build more and more disposable income, where are they going to put it? Are they going to put it in a stock market, which is likely going to go sideways, net sideways for the next decade as we experience a lost decade? No, they're not going to do that. Where are they going to put it? Well, they're going to put it in crypto, because this is what makes sense to them. This is what makes sense to the smarter generation. And of course, the millennials are smarter pertaining to Bitcoin, because it's far easier for millennials to understand this sort of stuff. This is far more intuitive to millennials and to Gen Z than it is to the older generation. An April 2019 poll showed that people aged 18 to 34 were 3 times more likely to be familiar with Bitcoin than those over 65. So there you go, that's exactly what I just said. Buyers in the Gen Z and millennial bucket make up to 94% of crypto buyers, compared to just 6.14% over the age of 40. But as you can see, millennials hold a huge chunk, and then millennials added to Gen Z hold a huge chunk, right? Boomers and Gen X hold very little crypto. And so just to reiterate this point, Bitcoin familiarity, percent that strongly or somewhat agree. And you can see that the older they get, the less likely they are to understand Bitcoin and crypto. Another reason that all of this money is going to flow into Bitcoin is we must be prepared for the most massive money printing bonanza in history in a final attempt to save the world. All sectors of the economy, individuals, companies, banks, local governments, etc., will be in need of financial support of a magnitude never before seen in history. Every single time they have to print more money, they print exponentially more than they did the time before. Because of this, the math is simple for Bitcoin. There are an infinite amount of people wanting Bitcoin, and there are only 21 million Bitcoin to go around. Of course, the real number is more like 17 million. 3 million are lost. 1 million are held by Satoshi. The number is significantly below 21 million. There simply isn't enough to go around. Let's take a look at the fear and greed by comparison. So in 2018 and 2019, this is back here, the fear and greed looks very similar to where we are now, doesn't it? In fact, it looks eerily similar. We capitulated in, small bounce, double bottom with a higher low, and then we went. Capitulated in, small bounce, double bottom with a higher low. So is this what's coming next? I think so. I think you think so as well. Is it really time to sell your Bitcoin? Not down here. I don't think so. Open to changing that opinion, of course, if we get another hot CPI print. Historically, Fed pivots equals strong rallies. Investors begin to price in an easier monetary policy with the tightening cycle finally in the rearview mirror. That's where we're likely inching closer to. And so you can see here, whenever the Fed pivots, we get a rally. whenever the Fed pivots, we get a big rally, and then we get the Fed pivot, big rally, and then we get the Fed pivot. So are we approaching the level in which the Fed can pivot? Well, of course, again, it all comes down to the CPI print. If the CPI print is lower than before, it will give the Fed a lot more breathing room. And here you see it, the next CPI reading is going nowhere but down, according to Game of Trades. I don't like this kind of speaking with conviction about something you can't really know, but Game of Trades is clearly confident about this. The 30-day SMA, simple moving average of oil price, has closed around 10% lower at the end of August relative to the end of July, which should prove to be a major drag on August's CPI reading. So is CPI going to come in cold? Of course, if it does, we will get this bounce out of the daily cycle lows. The stars seem to be aligned for a big bounce. Not many people believe in a bounce out of here. A lot of people are calling for recession. So it's going to be an interesting week. Saudi Arabia seem to know something, and they have been aggressively stepping up their purchases of US assets with inflows of $45 billion in a 3-month time span. So do you think the Saudis know something about oil? Do you think they know something about CPI? Do you think they know something about how to allocate their money? And do you think there's a reason that they're allocating it to US assets? So I'm going to say my goodbyes, and then I'll leave you with a nice clip that you can watch if you so desire. I'd appreciate if you could smash up that like button. Hit that subscribe button if you haven't already. Make sure you follow me on Twitter. I'm going to be playing patient, as I keep saying, until we get this CPI print, but then we are ready to go ham on the trades, whether that is to the short side on a hot CPI print, or whether that is to the long side coming out of these daily cycle lows, which is my expectation. Of course, I don't know. That's why I'm not jumping in front of any trains. I'm not trying to front run anything, because we're better than that. Instead, we're going to play patient until Tuesday, wait until we see what we get, and then we can entertain some long positions, I think. Or, of course, shorts if we get a high CPI print. So if you found value here today, I'd appreciate it if you could drop a like on the video. And I'm your boy Camel. All the best from me. Take care. Cheers. Bye.
The fact is that we're not going to, no one's just going to wave a magic wand and somehow get us back onto a gold standard. It's not going to happen that way. It might be quite disruptive. It might be only mildly disruptive depending on how it's done. But you still have to go through a transition period. The transition period will have to reprice gold to a level which allows it to be valued vis-a-vis the global asset base and global trade volumes in a way that implies equilibrium. What I mean by that is that today the gold price is too low to allow markets to clear because assets are overvalued vis-a-vis gold, and you need to rebalance the global economy such that you don't have these imbalances, which are huge, right, as a result of all the dollar accumulation as reserves through the decades of Bretton Woods. So the gold price needs to rise by an order of magnitude in order to allow that system to work. So you go through this phase transition when the price of gold has to rise by an order of magnitude. In my book, I go through some calculations what that order of magnitude would be. And indeed, they're based on calculations that have been made before by other economists, including under Bretton Woods. I mean, would you believe, we take it for granted today. We think, oh, gee, Bretton Woods is a stable system. It just worked. Nobody questioned it. That's not true. There was lots of debate and discussion during already the 1950s, but in particular the 1960s, that the U.S. money and credit supply was growing too quickly to be credibly backed by gold anymore and to allow Bretton Woods to function. And so there was already this dispute going on that gold was going to have to be revalued at some point. And indeed, gold was revalued before Bretton Woods broke down completely. They tried to go through a revaluation process, but it just wasn't enough. It didn't properly rebalance international trade, and it all blew up in the end when the U.S. basically lost patience with the rest of the world. So, that's how it happened then. But back then, the world was still very unipolar in political, economic, and military terms. It's far less so today. So I think today, the reevaluation that gold would have to go through to imply a stable international monetary equilibrium is huge. And by implication, according to my calculations, you're talking something in the region of about $50,000 per ounce being a reasonable market clearing price for gold if you fully go back to a gold-backed international monetary system.